So as you see, Ryanair remains the lowest cost airline group in Europe. We have the lowest fares, but also the lowest costs. We're number one for traffic. We grew to 149 million guests in the last 12 months. That would have been about 154 million passengers, but for the COVID-19 disruptions from the middle of March, the last month of the year. We offer more coverage than any other airline across Europe, but the big issue is that the COVID-19 pandemic has grounded our fleet since about the middle of March until we think July. Thankfully, Ryanair has a very strong balance sheet, and we believe our financial strength combined with lowest costs means not only will we recover strongly when air traffic returns to normal, but we'll be the long-term winner. You know these slides reasonably well. Our average fare last year was just €37, significantly cheaper than any other airline competing with us across Europe. We also have the lowest unit costs. Our unit costs last year were just €31 per seat, excluding fuel, significantly lower than all of our airline competitors here in Europe. Neil, do you want to take the results?
I will, Michael, thanks very much. As you said, a reasonably good year in FY20. Our traffic was up 4% to 149 million, and indeed it would have been 5 million ahead of that if it wasn't for the COVID groundings in March. Revenue per passenger up 6% to €57, and average fare grew by 2% to 37. Ancillaries had a strong performance where we saw 20% growth in ancillaries to 3 billion or 16% per passenger. Unit costs up 4%, 2 points ahead of where we'd originally expected due to the lost passengers in March. And profit after tax before exceptional items up 13%, just over €1 billion profit in the year. Balance sheet, one of the strongest in the industries, a triple B rated investment grade balance sheet with very strong assets. We've got in excess of 3.8 billion cash at year end, and indeed 330 unencumbered debt-free Boeing 737s with a book value of just over 7 billion, significantly higher on a market value. Cash burn has improved significantly, and we'll deal with the initiatives that drove that later on.
Thanks, Neil. So let's touch on current developments. Obviously, the COVID-19 crisis has grounded 99% of our fleet from the middle of March until we think until early July. The UK we've drawn down a 600 million loan under the UK government CCF loan programme, very low cost, and we qualified for that because of our triple B credit rating. As a result, that has strengthened the balance sheet. Our year-end cash at 3.8 billion has grown to 4.1 billion. And it's important to remember that we have 330 unencumbered Boeing 737s in our balance sheet at a book value of some 7 billion euros if we needed to raise extra cash, but thankfully we don't. Thanks to the tremendous work we've done on cost savings, the cash burn has been reduced from about 200 million a week in March to just 60 million per week at the moment. We're focused now though on getting the business back and getting Europe flying again. We believe that will be possible subject to the lifting government restrictions by about the 1st of July. We expect to operate about 40% of our normal July schedule during that month. We still need the waiving of some of the government movement restrictions, and we're also pushing back against some of the more absurd, ineffective and unpoliceable restrictions such as 14-day isolation periods. But we are actively campaigning for effective measures, which are face masks, temperature checks in public buildings such as airports, terminals, which we think would be much more effective than 14-day isolation periods which deliver nothing. We are, as Neil said, focused on beginning to take the MAX aircraft deliveries. We hope sometime between the period from October this year to March next year, subject to Boeing achieving a September return to service date in North America. And we'll brief you now on some short-term or some senior board changes that will take place at the end of the month of May. Just to give you an impact of how dramatic and sudden the COVID-19 pandemic has been in Europe. In both January and February, Ryanair Group delivered just over 10.5 million passengers, marginally ahead of our budget in both months. Our budget traffic for March was 11.6 million passengers. We fell 5.9 million passengers short, almost just over 51% less than the budgeted number. And for April, May and June, we're looking at carrying less than 1% of our normal targeted air traffic. So it has been unprecedented, it has been enormously disruptive. And to put it in some context, after the immediate 9/11 terrorist attack in New York, aircraft fleets were grounded for 3 or 4 days. We're now being grounded for about 4 months. And so the impact on the aviation industry, particularly here in Europe, will be severe. As I said, we think we can safely deliver a return to some flight services from July. We're hoping to operate about 40% of flight services in July, about 60% in August. We will be and have rolled out a video for customers and for our staff, effective health measures, which consist of masks, temperature checks. Our aircraft are fitted with hospital-level air filters. Nevertheless, there will be lasting impact on the airline industry in Europe. Thousands of EU airline jobs are being lost. Seat sales will be necessary to stimulate demand. We think that will result in weaker yields for the rest of FY21. One of the challenges we face is that EU governments are providing enormous sums of state aid, particularly to former flag carrier airlines, both in breach of state aid rules and competition rules. And this, we believe, is going to allow these flag carrier airlines to engage in massive and widespread below-cost selling for the next couple of years, which will put downward pressure on our pricing and yields, but deliver a stronger return to passenger volumes.
Okay, so just as Michael alluded to, we've put a lot of work into preserving cash and cost cutting over the past number of weeks. We've cancelled our share buyback programme. We've grounded over 99% of the fleet in all of Q1, and we expect to take a number of months before we're fully up and running again. We implemented 50% pay cuts in April and May, and that may go on for a longer period of time. We've had pay freezes, and we've benefited from the government payroll support schemes across Europe. We've eliminated all discretionary spend from the business, including non-essential capex, and we've deferred a number of payments. And we're not just happy to end there. We've got a number of other initiatives ongoing. We're currently looking at all of our bases across Europe. There may be some base closures this winter, or indeed into the summer. There are potentially up to 3,000 job losses and further pay cuts, mainly in the pilots and the cabin crew. We're actively engaged in negotiating with all of our airports for future growth from the Ryanair group as we get back to service later this summer. And of course, the game changer aircraft, the MAX, will hopefully start to come into the fleet in the autumn of this year, maybe around October, which will deliver significant savings, 16% unit cost savings on fuel, 4% extra seats and 40% less noise emissions. So it'll be absolutely a game changer. At the same time, we're in detailed discussions with both Boeing and our A320 lessors in relation to our growth plans going forward. And all of this has helped us reduce our reduce our cash burn and conserve our cash. Back in February, we were spending somewhere in the region of about 200 million a week. At the moment, we're spending about 60 million a week. Now, that may creep up slightly when we return to service, but I think we've done a very good job in holding on to the cash, and that will be what sees us through this crisis. A number of people have been asking and will be asking, what's the 350 million hedge and effectiveness charge in the P&L at the year end, and what does it relate to? Well, coming into the COVID crisis, we had 90% of our FY21 fuel hedged at pre-COVID prices and pre-COVID volumes. Michael has shown the drastic impact that COVID has had on our passenger numbers and on our requirements for fuel. We won't need to burn as much fuel this year, which means those fuel hedges have now gone ineffective, and we've taken a charge of 350 million through to the P&L in the current year. This will lead to a little bit of volatility in the profit and loss, as these hedges no longer enjoy hedge accounting and will have to be marked to market on a quarterly basis, but they'll wash out over the course of the year. There may be some more ineffectiveness if the return to service is slower than we hope and expect. Looking beyond this year, we've put in some hedges for FY22. We're 31% hedged at 541, and we have some currency hedging in place as well. Michael, back to yourself.
Thanks, Neil. So let's focus on state aid, which I think is going to be one of the huge challenges, or certainly one of the big competition distortions we face for the next number of years. Remember, across Europe, most airlines are participating in payroll support schemes. Transparent state supports like the UK loan scheme is not state aid because it's transparent and it's available to all companies or all airlines equally. What is, however, illegal state aid is this kind of national largesse to former flag carriers, none of which is justified or even necessary given the payroll support schemes that are already in place. However, the Lufthansa Group looks like it's going to receive about over 12 billion of state aid. Air France KLM over 10 billion of state aid, and Alitalia have now been cleared for 3.5 billion of state aid from the Italian government. This to a company that has never made a profit in the last 75 years. This is illegal. It is in breach of the EU's own state aid rules, and it's also in breach of competition rules because it entirely distorts the level playing field. The airlines who were strongest entering the COVID-19 crisis, the well-managed airlines like Ryanair, EasyJet, BA, will in many respects be the weaker airlines emerging out of the COVID-19 crisis, because we're now facing Lufthansa, Air France and Alitalia, who have enormous war chests of state aid, which they will use over the next number of years, firstly to engage in below-cost selling to damage competitors like Ryanair, and secondly they'll use it for M&A activity, which will allow Lufthansa, I suspect, to take over Condor and mop up other weaker competitors in their home markets. Ryanair will be opposing all of this illegal state aid in the European courts, but sadly that will take us a number of years to win those cases. And that's why, unfortunately, we have to address this immediately. We're in active negotiations with our unions across Europe. We need a minimum of 3,000 job losses from our pilots and cabin crew to reflect the fact that for the next 12 months we'll be lucky to carry 50% of our normal passenger traffic. And even that we do carry, we'll be carrying at artificially lower fares because we'll be competing with these flag carriers selling seats at below cost. And the 3,000 job losses will be the minimum we need on the assumption that we can negotiate 20% pay cuts, particularly with the unions. If we can't secure those pay cuts, we will need more than 3,000 job losses. If we can't secure those pay cuts, we're very hopeful that we can actually maybe reduce the 3,000 job losses, but we need urgent action from the unions quickly on these negotiations. As Neil said in relation to the 737 MAX, we have 210 on order, 135 firms, 75 options. We're hopeful that Boeing will achieve a return to service in North America in September. We will still therefore be targeting some deliveries of the MAX aircraft between October of this year and March of 2021. It is a great aircraft. It offers 4% more seats with 16% less fuel burn. It also delivers significant environmental savings in terms of reduced emissions, reduced noise. And we think that the MAX aircraft will be key to Ryanair's ability to continue to drive down operating costs and therefore take EU market share from other high-cost EU carriers once we recover out of the COVID-19 pandemic. The Boeing talks, as Neil has said, are continuing. We're in discussions with them about compensation for delayed deliveries. We're also reviewing pricing with them. We have a third strand of talks where we're looking at the possibility of a new MAX 10 order. But really, we can't conclude those negotiations until we have some certainty or some definition on when the aircraft will return to service in North America and when we can reasonably expect the deliveries of our aircraft. It's a great aircraft. We're believers in it. We think it will transform Ryanair's cost base for the next 10 years. Just to touch briefly on the board update, Stan McCarthy will take over as non-executive chairman for the 1st of June in 2 weeks' time. Louise Phelan will replace Kieran McLaughlin as the senior independent director. Sadly, David Bonderman and Kieran McLaughlin will leave the board on the 30th of May. I want to personally thank them on my own and on your behalf for the extraordinary commitment and service they've given to Ryanair over the last 20 plus years. We would not be Europe's largest and leading airline without the drive, the vision and the support that David and Kieran have given, not just to the other board colleagues but also to the management team over the last 25 years. Stan has done a review of the board. We're very pleased that in terms of gender diversity, 40% of the board for the 1st of June will be female. And we have, and will shortly announce details of refreshed committees. The audit committee continues to be led by Dick Milliken. Julie O'Neill will replace Howard Miller as chairman of the REMCO, and Stan McCarthy himself will replace Michael Corry as chairman of the NOMCO. Outlook. For the next 12 months, it's obviously impossible for us today to give you any guidance on either traffic numbers or on profits for the next 12 months. What we know for pretty much certain is we're going to carry almost no passengers in the quarter ending 30th of June, and we're looking at a a profit after tax loss in that quarter of something just over 200 million euros. We would hope to be back flying a reasonable volume of passengers in the second quarter, but even at that, we think the second quarter we're looking at probably a small loss, maybe break even, a small loss, but we have no idea because it is entirely subject to passenger numbers and yields and the lifting of government restrictions. However, we're taking appropriate steps to further reduce costs. We're in discussions, we're looking at base closures across Europe. We are looking at reducing our crew complement by about 3,000 pilots and cabin crew. We're talking about meaningful pay cuts in that area as well, as we've also reduced our head office numbers by almost 200 jobs during the period from March to June. Ryanair has a very strong liquidity and we've taken extraordinary cash preservation measures which have been reasonably successful. But we will need pay cuts, we need job losses, we need lower airport costs if we're going to right-size the business and right-size the cost base to compete with these European flag carriers who now have over 30 billion of state aid to fund below-cost selling against Ryanair for the coming years. We do expect lower airfares though to drive strong volume recovery once we get back flying, and particularly into 2021. I think it will be 2022 or later before we see a recovery in pricing. State aid will continue to drive down airfares, and we have no doubt that Lufthansa, Air France, Alitalia will engage in below-cost selling, but that is the ground on which Ryanair is strongest. We have the lowest costs, we have the lowest fares, and wherever there's below-cost selling, we will price below the below-cost selling by the flag carrier airlines. There is a unique medium and long-term opportunity at play here. Our competitors have either failed in the last 12 months or will significantly cut capacity post-COVID-19, and Ryanair would hope to take those additional deliveries from Boeing and exploit the opportunities that will undoubtedly exist as a result of competitor failure or capacity cuts in recent months.